Once again, one can imagine the magnitude of challenges central banks and other policymakers face in today's world. The Monetary Policy Committee met on 3rd, 5th and 6th April 2023 and assessed the macroeconomic situation and its outlook. It decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting with readiness to act should the situation so warrant. Let me read this sentence again. The Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC with readiness to act should the situation so warrant. Consequently, the standing deposit facility, that is SDF rate, will remain unchanged at 6.25% and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me emphasize that the decision to pause on the repo rate is for this meeting only. I would now like to explain the MPC's rationale for these decisions on the policy rate and the stance. While the recent high frequency indicators suggest some improvement in global economic activity, the outlook is now tempered by additional downside risks from financial stability concerns. Headline inflation is moderating but remains well above the targets of central banks. These developments have led to heightened volatility in global financial markets as reflected in sizable two-way movements in bond yields. Fall in equity markets and the US dollar shedding its gains from its peak of September 2022. Amidst this volatility, the banking and non-banking financial service sectors in India remain healthy and financial markets have evolved in an orderly manner. Economic activity remains resilient and real GDP growth is expected to have been 7% in 22-23. Consumer price inflation, however, has increased since December 2022, driven by price pressures on cereals, milk and fruits. Core inflation remains elevated. Looking ahead, headline inflation is projected to moderate in 2023-24. The monetary policy actions taken since May 2022 are still working through the system. Accordingly, the MPC decided to keep the policy rate unchanged to assess the progress made so far while closely monitoring and evolving the inflation outlook. The MPC will not hesitate to take further action as may be required in its future meetings. To recapitulate the actions taken so far, we have increased the policy repo rate cumulatively by 250 basis points in the last 11 months starting May 22. This was preceded by introduction of the standing deposit facility, that is the SDF, at a rate 40 basis points higher than the fixed rate reverse repo. Thus, the effective rate hike since April last year has been 290 basis points, 290 basis points. These increases have been fully transmitted to the overnight weighted average call money rate, that is WACR, the operating target of monetary policy, which has gone up from daily average of 3.32% in March 22 to 6.52% in March 2023. It is now necessary to evaluate the cumulative impact of these rate hikes. Under these circumstances, we have to be extremely prudent in our actions. We have always been very watchful and have adopted a calibrated and balanced approach and will continue to do so. When we started the rate cut cycle in February 2019 to provide support to growth, the CPI inflation was around 2% and the policy repo rate was 6.5%. Now the policy rate is 6.5%, but inflation is 6.4% as per the February reading. Overall, inflation is above the target, and given its current level, the present policy rate can still be regarded as accommodative. Hence, the MPC decided to remain focused on withdrawal of accommodation. What I now propose to do is to just briefly state about the growth and the inflation scenarios, and I will then try and sum up the broad approach which the monetary policy committee has taken, and I think that will give even greater clarity of what the monetary policy committee is doing. So let me first take up growth. As stated earlier, India's real gross domestic product, that is GDP, is expected to have recorded a growth of 7% in 2022-23. Hence, economic activity remains resilient. On the supply side, Rabi food grains production is estimated to increase by 6.2% in 2022-23. PMI manufacturing remained robust at 56.4 in March, recording expansion for 21 consecutive months due to favorable domestic demand. Service sector activity exhibited buoyancy. PMI services remained in expansion zone at 57.8 in March, driven by favorable demand conditions and new business gains. Aggregate demand conditions were resilient in Q4 of 22-23, even as private consumption showed some signs of slowdown. Urban demand indicators like passenger vehicle sales and credit card spending registered robust growth in February, while consumer durables contracted in January. Rural demand indicators such as consumer non-durables, tractor and two-wheeler sales registered healthy growth. Investment activity exhibited buoyancy on the back of government's thrust on infrastructure spending, high capacity utilization, and revival in corporate investment in certain key sectors. Non-food bank credit rose by 15.4% year-on-year as on March 24th, 2023. The total flow of resources to the commercial sector has increased by 26 lakh crore during 2022-23 as against 19 lakh crore a year ago. Merchandise exports and non-oil, non-gold imports contracted in February. Services exports continued to register robust growth. Supply chains are returning to normalcy globally as well as domestically. Looking ahead, the higher Rabi production has brightened the prospects for agriculture sector and rural demand. The steady growth in contact-intensive services should be positive for urban demand. The government's focus on capital expenditure, capacity utilization above long period average, and moderating commodity prices should bolster manufacturing and investment activity. The drag from the net external demand may continue due to increased global headwinds. The protracted geopolitical tensions and global financial market volatility pose downside risks to the outlook. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.5%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6.1%, and Q4 at 5.9%. The risks are evenly balanced. Let me now turn to inflation. The softening in inflation during November-December 2022 turned out transitory, with CPI headline inflation breaching the upper tolerance threshold during January-February 23. A sharp turnaround in food inflation drove the pickup in headline inflation as core inflation remained elevated across a range of goods and services. Looking ahead, the expectation of a record Rabi harvest bodes well for easing of food price pressures. There are already evidence of a correction in wheat prices in March on supply side interventions by the government. The impact of the recent unseasonal rains in some parts of the country, however, needs to be watched. Global commodity prices have moderated significantly from their heightened levels a year ago. As our surveys point out, cost conditions have somewhat eased. Inflation expectations of households have also eased down. On the upside, adverse climatic conditions are a risk to the future inflation trajectory. Milk prices are also likely to remain firm going into the summer season due to tight demand-supply balance and fodder cost pressures. The rising uncertainty in international financial markets and imported inflation pressures need to be monitored factors, and assuming an annual average crude price Indian basket of 80 barrels and a normal monsoon, inflation is projected to moderate to 5.2% for 23-24, with Q1 at 5.1%, Q2 at 5.4%, Q3 5.4%, and Q4 at 5.2%. The risks are evenly balanced. Now, let me now summarize what I have said so far. We are living in very volatile times. The sudden announcement of an output cut by the OPEC Plus a few days ago and the resultant jump in crude oil prices is yet another evidence of this volatility. The overall outlook thus remains dynamic and fast evolving. Our monetary policy in the recent period has aimed for a non-disruptive normalization from the pandemic era stimulus measures. Even as monetary policy moved decisively to withdrawal of accommodation, financial conditions evolved in line with the productive requirements of the economy. Growth has since then become broad-based. Inflation has softened from its elevated levels a year ago. However, it still remains above the upper tolerance band. Projections for 2023-24 point to a softening in inflation, though the disinflation is likely to be gradual and protracted given the rigidity of core or underlying inflation pressures. At this stage, we remain watchful of the evolving outlook and the impact of our actions during the past 1 year on the broader real economy. While we have kept the policy rate unchanged, it is important to bear in mind that this decision was taken on the basis of our assessment of the macroeconomic and financial conditions with reference to the information available up to today. Our job is not yet finished, and the war against inflation has to continue. And this has to continue until we see a durable decline in inflation closer to the target. Let me read again. Our job is not yet finished, and the war against inflation has to continue until we see a durable decline in inflation closer to the target. We stand ready to act appropriately and in time. We are confident that we are on the right track to bring down inflation to the target rate over the medium term. As we proceed towards this objective, I recall the wise counsel of Kautilya 2000 years ago, and he said, and his statement was as follows: Be not slack before the job is finished. Be not slack before the whole job is finished. I would now like to focus on financial stability. With the fight against inflation far from over, the global economy is now confronted with serious financial stability challenges from the recent banking sector developments in certain advanced economies. This calls for a reappraisal of the responsibilities of the regulators and the regulated entities world over and their collective role in safeguarding the stability of the financial system. While regulators need to identify potential vulnerabilities and take proactive regulatory and supervisory measures, it is important and incumbent upon the regulated institutions to exercise due diligence in their risk management and corporate governance practices. They need to pay close attention to asset liability mismatches and profile of their deposit base while building up adequate capital buffers and conducting periodic stress tests. It is in this context that we in the Reserve Bank of India have focused on macro and micro prudential measures in the recent years to prevent buildup of financial vulnerabilities. We have adopted a prudent approach towards regulation and supervision and have taken several steps in these areas in recent years. Some of these regulatory measures are listed in the footnote of this statement. Our supervisory systems have also been strengthened significantly in recent years. We have adopted a unified and harmonized supervisory approach for commercial banks, non-banking financial companies, that is NBFCs, and urban cooperative banks, that is UCBs. The focus is now more on identifying the root cause of vulnerabilities rather than dealing with the symptoms alone. As a result, the Indian banking system remains sound and healthy with strong capital and liquidity buffers, improving asset quality, better provisioning coverage along with improved profitability. Nevertheless, we are keeping a close watch on the banking sector turmoil in some developed countries. In this context, let me once again recall Kautilya's wisdom, which remains relevant even for today's world. And I quote, "In the interests of the prosperity of the country, we should be diligent in foreseeing the possibility of calamities, try to avert them before they arise, overcome those which happen, remove all obstructions to economic activity." I would now like to touch upon liquidity and financial market conditions. The Reserve Bank will continue to adopt a nuanced and agile approach to liquidity management. Amidst large moderation in surplus liquidity, the Reserve Bank conducted 14-day variable rate repo auctions, which is the main operation on February 10th and March 10th, and also a fine-tuning 5-day variable rate repo auction on March 24th. In the period ahead, the Reserve Bank will remain flexible in meeting the productive requirements of the economy through two-way operations as may be necessary. We will also ensure the completion of the government borrowing program in a non-disruptive manner while maintaining orderly market conditions during 2023-24. The Indian rupee has moved in an orderly manner in the calendar year 2022 and continues to be so in the current year, that is 2023 also. This is reflective of the strength of the domestic macroeconomic fundamentals and the resilience of the Indian economy to global spillovers. We remain watchful and focused on maintaining the stability of the Indian rupee. Let me now turn to the external sector. The current account deficit for the first 3 quarters of 2022-23 stood at 2.7% of the GDP. In third quarter, current account deficit narrowed significantly to 2.2% from 3.7% in the second quarter on account of lower merchandise trade deficit and robust growth in services exports. Strong software services export growth was witnessed across key verticals such as IT services, business process management, and engineering and research design, supported by a rise in global capability centers. The merchandise trade deficit further narrowed during January and February 2023 from its level in the third quarter of 22-23 on the back of a sustained decline in imports. Moreover, India's services exports continued to grow at a healthy pace in the first 2 months of the current calendar year, that is 2023. Better growth prospects of the Gulf Cooperation Council, that is the GCC countries, are expected to keep remittances robust. In fact, inward gross remittances into India touched an all-time high of $107.5 billion during the calendar year 22. The current account deficit is expected to remain moderate in the fourth quarter of 22-23 and also in the year 23-24 at a level that is both viable and eminently manageable. Overall, our external sector indicators have improved significantly. Foreign exchange reserves have rebounded from $524.5 billion on 21st October 2022 and now stand in excess of $600 billion taking into account our forward assets. I shall now announce certain additional measures. There are 5 of them and they are very important. I request your patience. The first announcement relates to developing an onshore non-deliverable derivative market. Banks in India with IFSC banking units, that is IBUs, were earlier permitted to transact in Indian rupee non-deliverable foreign exchange derivative contracts with non-residents and with other eligible banks having IBUs. It is now proposed to permit banks with IBUs to offer non-deliverable foreign exchange derivative contracts involving the Indian rupee to resident users in the onshore market. This measure will further deepen the forex market in India and provide enhanced flexibility to residents in meeting their hedging requirements. The second announcement relates to enhancing efficiency of our regulatory processes. At present, the processes for entities to make applications seeking license or authorization or regulatory approvals from the Reserve Bank under various statutes and regulations take place in both online and offline modes. To simplify and streamline such processes and in line with the Union Budget 23-24 announcement, it has been decided to have a secured web-based centralized portal named as Prabha for such processes. The portal will show time limits for deciding on the applications or approvals sought. This measure will bring greater efficiencies into regulatory processes and facilitate ease of doing business for the regulated entities of the Reserve Bank. The third announcement relates to development of centralized web portal for the public to search unclaimed deposits. At present, the depositors or beneficiaries of unclaimed bank deposits of 10 years or more have to go through the websites of multiple banks to locate such deposits. Now, in order to improve and widen the access of depositors or beneficiaries to information on such unclaimed deposits, it has been decided to develop a web portal to enable search across multiple banks for possible unclaimed deposits. This will help depositors and beneficiaries in getting back their unclaimed deposits. The next announcement relates to grievance redress mechanism relating to credit information reporting by credit institutions and credit information provided by credit information companies, that is the CICs. Recently, the credit information companies, that is CICs, were brought under the purview of the Reserve Bank Integrated Ombudsman Scheme. It is now proposed to put in place the following measures. 1. A compensation mechanism for delayed updation rectification of credit information reports. 2. A provision for SMS email alerts to the customers whenever their credit information reports are accessed. 3. A time frame for inclusion of data received by the CICs from credit institutions. And 4. Disclosures on customer complaints received by the CICs. These measures will further enhance consumer protection. The last announcement relates to, and this is very important, if you recall, almost in every monetary policy meeting and even otherwise, the Reserve Bank, we have been making a lot of announcements relating to the UPI. And this announcement also relates to UPI. Basically, the objective is to widen and expand the footprint of the UPI even further. And this announcement relates to operation of pre-sanctioned credit lines at banks through the UPI. The Unified Payment Interface, that is UPI, has transformed retail payments in India. UPI's robustness has been leveraged to develop new products and features from time to time. Recently, RuPay credit cards were permitted to be linked to the UPI. This was in addition to the existing facility of linkage of UPI with deposit accounts. It is now proposed to expand the scope of UPI by permitting operation of pre-sanctioned credit lines at banks through the UPI. This initiative will further encourage innovation. Let me now conclude by stating that since early 2020, the world is going through a period of extreme uncertainty. In this daunting environment, India's financial sector remains resilient and stable. Overall, the broadening of economic activity, the expected moderation in inflation, the fiscal consolidation with focus on capital spending, the significant narrowing of the current account deficit to more sustainable levels, and the comfortable level of foreign exchange reserves are welcome developments which will further bolster India's macroeconomic stability. This allows monetary policy to remain unwaveringly focused on inflation. With underlying core inflation, or rather with unyielding core inflation, we remain firm and resolute in our pursuit of price stability, which is the best guarantee for sustainable growth. Let me read again. With unyielding core inflation, we remain firm and resolute in our pursuit of price stability, which is the best guarantee for sustainable growth. The impact of our actions over the past 12 months is still playing out and would increasingly weigh on the future inflation trajectory. As I noted in my policy statement in April last year, our goals of price stability, sustained growth, and financial stability are mutually reinforcing, and we continue to be guided by this approach. We remain vigilant and ready to face the challenges with a firm commitment to price and financial stability. We are inspired by what Mahatma Gandhi had said, and I quote, "Inexhaustible perseverance and patience knows no defeat." Thank you. Namaskar.
All ends up, it is a positive for the markets. There has been
Well, hello and welcome. This is the live coverage of the MPC's rate decision. Let me first recap what's happened. Well, it was a surprise. Contrary to expectations, the RBI has held repo rates, in fact has kept repo rates unchanged at 6.5%, and the vote was a unanimous one. The withdrawal of accommodation stance has been retained, and Governor Shaktikanta Das has also said that the present policy rate pause is only for this policy. So he has kept the door open for future hikes in light of what happens globally. And aside of that, the governor has also hiked the growth estimates for FY24 marginally from 6.4% to 6.5%. Interesting to note that the inflation forecast for FY24 has been cut to 5.2% from 5.3%. Let me get on board our consulting editor N. Mahalakshmi to get in the first reaction on what she makes of the policy and the governor's announcements. Would you call this a hawkish pause, or would you call this a dovish pause? And contrary to expectations, none of us were expecting the governor to actually pause at this juncture. We were factoring in a 25 basis point rate hike at least for this time and then go for a pause.
Yeah,
but the governor has sprung a surprise.
Absolutely, absolutely, Nandita. This is, you said it exactly. It is a hawkish pause. I wouldn't call it a dovish pause, because the moment he said pause, the next sentence he said was that this is a pause. Let me reiterate that this is a pause only for this meeting. And he didn't say that there could be rises further, but that is what he means. And of course, the ending quote that also stood out, because he quoted Kautilya saying that be not slack before the whole job is finished. And this is exactly the tone that has been coming from the US, from the Fed chair. And essentially what it means in the US, of course, there is a long way to go till they get to 2%. Our range is slightly higher. So therefore, our journey, and we're also used to this kind of inflation. But for us, the important thing is also to not be absolutely uncompromising about growth, you know,
right?
Because that is how the world looks at us, and we shouldn't be compromising on growth. And we are used to a slightly higher rate of inflation. So yeah, it is what exactly you said is exactly what it is. It is a hawkish pause.
So don't you find this surprising that the RBI governor has slashed the inflation forecast, albeit marginally, to 5.2%, given the fact that we have a risk of El Nino, we have had unseasonal rains, crop damage and, weather fluctuations, and then food prices are also going up. We have milk prices going up.
Yeah.
So, in the face of all this, in spite, in fact, not revising the inflation forecast upward but downwards, what does that communicate?
No, I think the signal was fairly clear that, I mean, there would be softening of inflation going forward. No doubt that the core inflation has been strong and sticky. There is no change in that. But it's a moderate, I think it's not a very big cut as far as I can see. And also, if you just read the subtext and sentence by sentence what the governor said, he also said, he talked about the, OPEC thing that happened, right? OPEC production cuts. Emphasizing the fact that this is the kind of volatility that we face, and therefore we need to be watchful. So I wouldn't read too much into how they're looking at inflation. What is that exact, 10 basis points up or down? Right now, the trajectory seems to be set, and the policy tone seems to be set, and which has been fairly consistent also. And I think it's a good policy. It's a good idea for us to, at this point in time, even when the US is going soft on rate hikes, it is a good idea for us to be a little liberal about it, stay the course, warn the markets, and so that they don't become complacent about any possible hikes in future. And I wouldn't read too much into this. I think these are evolving things. The risk that you talked about, whether it is monsoon or El Nino or whatever oil prices, all these are still imponderables. But by the way, I think there is room in terms of crude management, because crude is really not something that has hit the CPI so far, because it is managed at the government level. Our levels, prices are already elevated, and we have not passed on the benefits of, we had not passed on the benefits of lower prices, and therefore there is no risk to the upside also. So I think some of these factors like food prices, definitely we have to watch out. Milk prices, like you said, has been strengthening. Food prices, there is a risk, but we don't know how that is going to play out. So I think it's largely on expected lines. Majority of the market was looking at a 25 basis point. So obviously markets have a reason to cheer today. But how long that should last and how seriously we should take this pause, obviously we shouldn't be complacent. We shouldn't be complacent.
Let me also get on board Ravi Krishnan of Moneycontrol Pro, who's joining in. Good morning, Ravi. Good to have you on the show. Well, a surprise by the RBI governor, in fact, a positive surprise, at least for this time, even though he's left the door open for more rate hikes in future. What is your key takeaway from the governor's speech and, the adjustments that he's made to growth as well as inflation forecast?
We all knew that it was going to be tough. I mean, for 6 consecutive rate hikes, he was quoting Mahatma Gandhi, who was closer in time. But to justify a pause, he had to quote Kautilya twice, from 2000 years ago. But I mean, leaving aside the lighter note, I think, they are clearly waiting for the lagged effect of monetary policy to show through. I mean, 250 basis points of hike in 11 months. Most people are saying that we have already surpassed what should be the ideal terminal rate. I mean, it's already 6.5%. So from that point of view, there are clear justifications for a pause because we don't know what kind of growth sacrifice it will entail, whether they have destroyed demand enough, etc. But having said that, he also emphasized, I think, 3 or 4 times that the fight against inflation is not won. Uh, so, in terms of signaling, I do think that this is a slightly confusing kind of pause from the Monetary Policy Committee as a whole. Maybe they would have been better off by going in for one more 25 basis point rate hike and then clearly, signal saying that, maybe that would be the end of the cycle. But right now, as Malakshmi also pointed out, what the reduction in inflation is marginal, what they have projected, and adverse climate changes, food inflation, imported inflation, these are all, are clear upside risks to inflation. Core inflation has been sticky for, I mean, ages now. So given all this, I think it's a slightly confusing stance which they have taken.
A slightly confusing stance. Hold that thought, Ravi. I'll come back to you. But also joining me is Tanvi Gupta Jain, who's the Chief India Economist of UBS Securities. And we also have Jaideep Iyer, Head Strategy at RBL Bank, joining in the panel discussion. Let me come to Tanvi first. Tanvi, good to have you joining us this morning. What are your thoughts and what is your key takeaway from the governor's speech, given the fact that he has reiterated a couple of times that the war against inflation is not over. Even then, he's revised his inflation forecast for FY24 slightly downwards. What would you say? What would your key takeaway be from the governor's speech?
So I would agree with your initial statement that it looks like an hawkish pause. So we were estimating a 60% chance of a rate hike by 25 basis point. But what we have seen over the past few weeks that the global financial market volatility have rose, leading to recent global banking turmoil. And even though the contagion has been halted, because of these emergency backstop measures, but again, there is always an increase in global volatility. And very interestingly, in one of the RBI bulletin, I think RBI also mentioned that there was a trade-off between financial stability concerns and the conduct of disinflationary monetary policy. So at today's policy, if you look at what the RBI has done, they have clearly paused. I think after 250 basis point of rate hike, they are clearly highlighting that they will be looking at the lagged impact of monetary tightening overall on both domestic demand as well as the inflation trajectory overall. When I look at my inflation forecast, it is showing that inflation is going to ease or soften significantly in the month of March, the data which is getting out on 12th. And at the same time, it will continue to moderate over the next 2 months, specifically till the June quarter. So in our baseline forecast, we are maintaining our view that after an extended pause, the next move will actually be a cut. We are not of the view that there will be more rate hikes in the offing. So we are building in actually a 50 basis point rate cut in second half of FY24 based on a sharp Fed pivot, which our UBS US team is building at the moment.
Right. Tanvi, that was going to be my next question, whether or not we'll see 6.5% as the terminal rate. And you've clearly answered that. But when do you expect the RBI to then tinker with the stance? Do you think that could happen in the next policy if you are expecting the March inflation figures to soften?
I think that will also be a function of what is the Fed going to do. Are we expecting one more rate hike by the Fed in the May policy, or there will be a pause in that rate? Because I think that again is a close call. If the Fed actually ends up being announcing a pause because of the global banking turmoil, then I think in the next policy, even RBI could actually change the stance from withdrawal of accommodation to neutral. In our base case, our UBS US team is estimating Fed to begin easing from this month of September onwards. And in our base case, we are expecting the first rate cut in the December policy, December 2023.
So first rate cut in December 2023, that's what UBS is expecting. Hold that thought, Tanvi, we'll come back to you. Let me also get in Jaideep from RBL Bank to come in. And good morning, Jaideep. Good to have you on the show. Share with us your initial thoughts on what the RBI governor has done. It's a positive surprise. It's a breather of sorts for home loan borrowers, at least this time. What are your thoughts? How would it impact the entire banking system?
No, yeah. So I think it's a good thing to do. A couple of points on the lagged effect of monetary policy. If you look at a banker's view, I think the deposit rates have gone much more than, at least the short-term deposit rates have gone significantly higher than the 2.5% that we've seen repo height over the last 11 months or so. So clearly, I think it is sensible to wait out for the impact of the hikes that have happened so far, and it's been probably a fairly sharp rise in the 11 months that we've seen in the historical. Let's say if we take a 10-20 year view. So that's one, and I think yes, it is a relief for retail borrowers because since the banking system moved towards an external benchmark linked rates. Banks have not much of a choice but to pass on for the existing customers the rate hikes, and 2 to 2.5% rate hike would mean tenors have gone up for home loans quite significantly, and any rate hike from here on would largely translate into EMI increases. So I think it's good from that perspective. We had already seen demand come kind of slowing down for home loans at least. So that's one. And I think the second point is that RBI, unlike the US Fed, probably believes in not overshooting either way, right? So, I mean, I think US went down to zero and stayed there for a long time. And then, we are already sensing that, you're right now in the rate hike cycle in the Fed and people are talking about cuts within 6 to 9 months. I think the RBI probably prefers it to be a more let's say nuanced in terms of increasing and then not immediately cutting. So I would expect a longish pause, at least for the current fiscal, before there is a change in stance.
Right, a longish pause is what you'll be expecting. Tanvi, my next question to you is, a lot has changed since the Fed meeting. We had some big banks in the US going belly up. We had Credit Suisse rescue. Many experts have said that, it's not as severe as the 2008 financial crisis, but it is not going anytime soon. What kind of an impact do you do you expect this crisis to have on India, even though RBI has maintained that our financial system is far stronger when it comes to regulations and when compared to US?
Sure. So when we did our math, it looks like India will likely have a very limited spillover from the strains what you're looking either in the US or the European banking sectors. Obviously, there is a trade-off between the financial stability concerns and the monetary policy. But at this point, in our base case scenario, I think India will have only a limited spillover. In terms of even the global growth scenario, I mean, if I look at what is our UBS team talking about the US economy, we think that US economy is going to see a hard landing. In fact, we think that the Fed is nearing the end of the hiking cycle with 25 basis points still priced in our forecast. But again, we will monitor how the data is going to pan out. If the global economy slows down, and especially US and Europe, the sensitivity for India for every 100 basis points slow down in G2 GDP growth is somewhere around 40-45 basis points. So it's not that India is immune, but I would say it is one of the low beta economies to any slowdown in the global economic environment.
Right. Jaideep, coming to you, lots of Q4 updates are trickling in from some of these private banks. Credit offtake remains strong. We've got loan and deposits also, deposit growth also remaining healthy. But, deposit rates had never seen before levels around 7 to 8%. Now, how much of a risk does it pose to bank margins in the coming quarters?
Yeah, I think so. The last 6 months or so, the banks had the benefit of repricing the loans, largely retail loans, upwards because of the repo increase. At least the floating rate loans went up in tandem with the repo rate hikes. But the deposit increase, yields on the deposits or cost of deposits went slower up. And I think that catch up will happen over the next 6 months or so, at least 3 to 4 months. So I guess the first half of the current fiscal should be like-to-like basis, slightly negative margins. But I'm sure banks then work towards, changing the mix of their products, go a little more unsecured, et cetera, et cetera. But like-to-like, I think there'll be some pressure on margin for banks in the first half of this fiscal.
All right, some pressure on margins expected for banks in the first half of the fiscal. Let me come back to my consulting editor N. Mahalakshmi. ML, markets are pretty much okay with what the RBI governor has done. We are seeing quite a bit of an uptick in the realty pack. That was up over 1%. Autos and banks also reacting positively. Do you think markets are also factoring in a longish pause, as most of the economists on our panel seem to believe?
Okay, this is where I wanted to actually butt in, because you're talking about this longish pause. I think the markets kind of ignore, we have so much recency effect that we tend to ignore history. One year and saying that we have come this far, rates have gone up so much and we've not seen that affect the economy. We are really worried about how that is going to pan out for growth in the US. And obviously we are, we can't be completely on a different trajectory when the world markets are in a different zone where every other central bank is hiking rates. Now here it is important to pause, for us to pause and take a look at history. If you look at, 1980s, Fed rates were as high as 22%. We have seen a very long period where we have had very low interest rates, 0, 1%, 2% for the longest time. And now we are looking at a rate hike cycle. And we think that, 4.5%, 5.5%, these terminal rates that we talk about, whether it is for US or for India, there is nothing set in stone. This is the anticipation of the market today. And if you were to read the subtext of what the governors are trying to say, is that they are now, at least in the US, it's very clear to me that the Fed chair is serious about his main objective, which is controlling inflation. So, of course, they don't want to do it in a way that disrupts financial stability, because that is a key concern as well. But we can't rule out till, the idea is to push it to a level that something doesn't break. So we will, instead of taking a preemptive step that, we should not allow things to break, which I think is the Indian stance, the US stance is push it to the limit and see where it breaks. And then we will see what else to do. For example, because SVB happened, there is a softening of stance there. So I think they will continue to push the limits. It will be a little bit, one up or a one down sort of a trajectory, but we should not completely rule out the possibility of these terminal rates getting reset even higher as we go into the next few quarters. So we have to be open in the markets. We have to be open to that possibility as well, because this is coming. This kind of a shift is coming after a very, very long time. Now, the question about markets. Markets are obviously not, factoring that at all, because we are not, the kind of correction we have seen is substantial in the US, not so much in the US, in Indian markets. We have been, in terms of equity markets, pretty much where we were last year. It's not a substantial erosion. But that is also because we have been able to demonstrate substantial, robust growth. And that demand is not really, is not contracting. It has been substantial. Credit growth continues to be at 15%. And if we are able to sustain that, then I think we'll continue to have, we may not be able to rally in an environment which is not set to rally, but it may not be too bad also. But it will be important for us to sustain this 15% credit growth. Already durable sector, for example, is contracting. Automobiles is doing better. So bits and pieces in markets also, there is no coherent theme that is really emerging. Yeah. That, either there is demand contraction in all the rate sensitive, that's not happening, because you should have seen a lot of contraction in automobiles, which has not happened. Right. Durables, because it had great years post-COVID, it seems to be decelerating now. So properties saw a lot of, demand last year around the same time, but it went, it slowed down a bit in the months thereafter. Now you again see some kind of resurgence in luxury homes, etc. So it's all, growth is happening in pockets. Right. So as investors, I would say we have to be very, very cautious of, about, you can't take a call on the entire market or entire sector today. You have to become very stock specific and place your bets accordingly.
Right, time to be stock specific as no particular theme is emerging in the markets at the current juncture. Tanvi, let me come to you. You were talking about, the March inflation figures coming in lower according to your estimates. So would you expect inflation for the month of March to slip below that 6% mark, or do you expect it to come around that 6% mark?
For March, my inflation number is definitely coming below 6% mark. In fact, it is coming somewhere in the middle, slightly around 5.5 or slightly below. We are just updating our models and we realize that the cereal inflation has corrected quite significantly in the month of March. Obviously, the Food Corporation of India had released stocks of wheat, so that would have helped cool off the prices. Milk prices continue to stay elevated. There is some base effect at work, which is helping. Plus, global commodity prices ease, that again is helping. So yes, the inflation momentum is easing significantly, or at least it is coming below that upper threshold level of 6% in the month of March. Even in the months of April, May, I'm again seeing that inflation momentum is only easing from the levels which you're going to see in the month of March. So which is a positive sign that at least the headline numbers will start looking good. Obviously, there's a lot of uncertainty at this point. One, regarding the Rabi crop harvest, because we did see unseasonal rainfall in parts of India. So we will get to know the exact amount, how much exactly, the harvest has been, the yield has been, and how much has been affected because of unseasonal rain. And second is the El Nino risk, because if you look at the US Weather Department, they are highlighting a increased likelihood of El Nino impacting, and mostly should impact India in the second half of our monsoon season. So what again it will have implications on the food prices is something which is definitely worth monitoring, because food has a highest 46% weight in our CPI basket. But other than that, at least in the next couple of months, I think the trend is softening, which is good for the markets. People will see easing of the macro stability risk, both on the current account, both on the inflation.
Right. Let's also talk about growth. Recently World Bank has scaled down India's FY24 growth forecast to 6.3%, but RBI Governor has, increased marginally, albeit the growth forecast for FY24 to 6.4%. What are your own estimates for the next fiscal, given the fact there is a chance of a looming recession in the US?
We are actually below consensus on our FY24 real GDP growth forecast. Our UBS view is 5.5% real GDP growth forecast, which is way below RBI's today's, upgraded GDP forecast of 6.5%, and even the consensus is somewhere around 6%. So yes, I would say we are already seeing signs of moderation or softening in the growth momentum as per our lead indicators. And where we are, I think, different from the street are basically on two counts. One, we do expect consumption reopening tailwinds, which have already begun to fade, to actually normalize as we move into FY24. And there is going to be a lagged impact of monetary tightening on consumption spending. At the same time, we think that the corporates are going to postpone their investment or capex plans going into FY24. One, on demand uncertainty, global volatility, and at the same time in the run-up to the 2024 elections. So I think that is where we are differing from the street, and we are below consensus at 5.5%.
5.5 is what UBS is predicting for FY24. Coming to you, Jaideep, data has shown that, credit growth was strong in March, in fact, led by retail, which was 20% YOY, MSME to somewhere around 13%, and services 21%. But, the problem area was credit to large industries, that was somewhere around 7% on a YOY basis. Do you expect a pickup in credit to large industry anytime soon in the current fiscal?
That's something that we've been waiting for a long time, and I don't think it's coming in a hurry. Ironically, today's paper spoke about Hindalco still going easy on its capacity expansion. So we are still, broadly speaking, on the manufacturing side, still in the early mid-70s in terms of capacity utilizations. And I think while some sectors where government intervention has clearly played a role, which is cement and steel, I think there we have seen, there we will see capex plans coming through. But in general, I think I don't think that's rapidly growing. It will inch up a little bit, but the main driver for growth over the next 12 months is still going to be retail.
All right, retail to be the main driver of growth. Another question on liquidity then. Do you think that is something that will be an area of concern, given the fact that the TLTRO that was announced in COVID time is also ending in April?
Well, I think so. Obviously, now the banks are getting used to a neutral liquidity scenario for a while now. For the last few months, we've seen liquidity being negative as well for many days, and that impacts. We've seen call rates go up beyond policy rates as well in the last few days. So I think banks are okay as long as there is, there is comfort that RBI is managing this, proactively and not let it go out of hand. Both sides. Clearly, they are not going to allow excess liquidity hang around in the system. So to that extent, I think we are all used to being in this zone. And as long as there is comfort that we don't go to minus 2 lakh, minus 3 lakh crores, and there is panic in the short term, which I think RBI will not allow, I think that's now not a big deal. And therefore, the short-term rates will hug the repo rate, maybe marginally higher or in that zone. What is critical is that we are already seeing deposit rates of close to 8% for 1 year or even 9 months, and I think that can go up a little more. So short-term liquidity, as long as I mentioned, we are in the zone of minus 50 to plus 50, I don't think that's a big deal.
Right. Another thing I wanted to ask you was, the government's recent move to bring debt funds at par with FDs, because obviously indexation benefits have been removed and, they will be taxed at short-term capital gains tax rates, right? So that, of course, means that, we are looking at more fixed deposits as investments. Would that be a big boost to banks?
There'll be some tailwind will be there. In fact, according to me, it's not only deposits, it's also lending opportunities because, debenture market will go down for corporates and NBFCs. So it's on the both sides of the balance sheet. But it will be a slow improvement in the sense that approximately my estimates are that new money into debt funds would be in the zone of 1 lakh crore, 1.5 lakh crore. Existing money is not going to go out because taxation is grandfathered. So we will see a benefit to banks on both sides of the balance sheet, where intermediation is more back on the table as we compared to mutual funds. So, but I don't think it's a dramatic change.
Right. Let me come to Tanvi then. Tanvi, we saw a couple of banks, go belly up in the US. Would you say that the worst of the US banking crisis is over, or is it still unfolding? And given the fact that interest rates in US are around that 5% terminal rate, do you think more banks or regional banks are staring at the risk of failure?
Okay, so I would basically highlight one view. We believe the contagion has been halted, especially after these emergency backstop measures, and they have kind of averted a deeper crisis of confidence. But whether this global banking turmoil is over, I think it is a very, very fluid condition. We'll get to know over the coming weeks and months on how it is unfolding, but definitely that contagion risk, which has increased a lot over the last few weeks, that for now has been taken care of. But if I look at global financing conditions index, which we maintain, especially even for India, the India Financing Conditions Index, that is again tightening. Credit conditions globally are tightening, which definitely has a downside to global GDP. And I don't see India's growth number will remain unscathed because of that.
Right. So are you saying that, unlike other economies, can we still look at growth over inflation? Because our external sector remains strong, given the fact that CAD is well under control. We had services exports also coming in pretty robust. So in that view, can we take, unlike other economies, can we choose growth over inflation, even though the RBI governor has said that the war against inflation is not over yet?
So it depends upon to what is our what is the level of inflation we are okay with. So till the time we are okay with inflation in the 5 to 5.5% range, I think we will focus on growth. If our focus is that we want to bring inflation down to 4%, that looks quite difficult at the current juncture, especially with oil prices going up. So if we are okay with 5.5% inflation handle, and in our forecast, we are expecting RBI to go for an extended pause before starting an easing cycle, I think over the coming months, the focus will be coming back on the growth front. And And at the same time, I think inflation, there's a lot of administrative fiscal intervention which can be taken to cool off the prices. For example, when oil prices corrected to $70, $75 a barrel, we never saw the retail prices of gasoline or diesel, going down. And now when oil prices have moved higher, no one is expecting too much of a change in the retail prices. But if there is an opportunity that versus an average of $95 oil last year, this time the oil starts trading and, we assume the RBI's focus of $85 a barrel, there's definitely a headroom to bring down the retail prices of gasoline and diesel, which will bode well for even the inflation and the input cost pressure being faced by the companies, which has resulted in quite an elevated CPI, core CPI inflation number. So I will say in the run-up to the 2024 inflation, definitely growth becomes a priority, but at the same time, there has to be administrative and fiscal intervention needed to cool off the prices domestically.
Right, since you mentioned crude, I wanted to ask you, what are your own estimates of where crude is heading? Because, we had a couple of brokerages like Goldman Sachs saying that $95 is where crude will settle around this year. But do you foresee $100 now, given the fact that OPEC has announced a surprise cut and there are chances of more cuts going forward this year?
So if you look at our oil team, we are basically relying on oil futures, and we have taken oil at $80 a barrel in our base case forecast. And we are estimating oil prices at 85, remaining at 85 in FY24, remaining 3 quarters. So I would say roughly around 80, 85 is where we are in the base case. So very, very similar to where RBI is at the moment. Whether oil will trade at 90, 95, at this point, we are not assuming in our forecast. So yes, there is always a risk depending upon the supply situation and the OPEC decision on price outlook. But at this point, we are also very close to where RBI has taken in their numbers. So at this point, even if you exclude oil, we can see other global commodity prices, especially coal prices, which is also a positive. Oil, even if it averages $85 a barrel, it is still a $10 barrel, slow down, a lower number versus last year, which is bodes very well for our current account balance because it will reduce our oil import bill by almost $15 billion in FY24.
Right, Tanvi, hold that thought. We also have Lata Venkatesh joining in with her first take on the RBI policy, the surprise pause as well as the governor's statement. Lata, good morning. Thanks a lot for joining in. Something that we were talking about, a hawkish pause?
Yes, that's exactly what they have done. You wrapped it up very nicely. I think the expectation, this is a bit of an arithmetic as well. After all, the fourth quarter of last year, Jan, Feb, March, that inflation is coming in much higher than what the Reserve Bank had forecast. They expected 5.7, it will come in at about 6.2, so a good 50 basis points higher. So on that base, if you looked at next year's Q4 inflation, clearly because of the high base, that has been brought down from a forecast of 5.6 to 5.2. Now the Reserve Bank normally wants the 1 year ahead interest rate and the inflation to have a difference of about 125, 150 basis points. So if you take 520 as inflation and the rate is already at 6.5, there is a difference of 130 in terms of positive real rates, and that may be the argument for going for a pause because they are bringing down the inflation target. The other reason for the pause, of course, could be that the world is in a fragile place at this point in time. Why not wait? And that's why they've given all indication that if the need arises, they will go ahead. And there could be a need. What if the jobs data from the US came in very robust? What if the Fed, therefore, in the days to come indicated that it will go ahead with not 1 but 2 more hikes? What if crude became unmanageably high? What if producers find enough space to pass down the prices and therefore there is a general rise or stubbornness at least in core inflation and it doesn't come down? So they have maintained that flexibility that if all these factors work out, they could increase rates as well. So my interpretation is that it's a very good decision to take to, pause at this point in time, but not say we are done for now. Nevertheless, the market has taken home the message that they are done and that they are not going to hike. I mean, if you don't hike when the last inflation number is 6.4, how are you going to hike when the last inflation number is 5%? And the incoming inflation number is also going to be 5.2 or 5.4. It looks a little unlikely. So perhaps the peak has been reached. That may be the risk also. The Reserve Bank is now pretty far away from the 4% target. They have not reached that target for the last, 30 months? And they don't look like they're going to reach it for the next 24 months. So have they given up on the 4% target altogether would be a very important question that people will ask the governor. The second big surprise element is they've actually upped the growth forecast. That's a bit of a surprise. Already 6.4, they're higher than any other forecast on the street. At 6.5, they are even higher. So one would want to know what are their inputs to make this number higher. I think the Reserve Bank has taken a lot of comfort from the fact that we don't have a current account deficit problem. Service exports are doing very well. So we really don't have to go lock in step with the Fed. We can afford to have an independent policy. That must be the third factor working on their minds.
Right, ma'am. You're talking about inflation, but they have also scaled down the inflation forecast for FY24. But look at the bond market reaction. The bonds have rallied. And what would you suggest? Do you think that this is the last rate hike, as the markets have taken that message? But have you also taken that message that, after this we are in for a prolonged pause, notwithstanding the fact that we are staring at El Nino risk and, of course, the risk of higher food inflation?
I think what the market is taking home and what one should legitimately take home is a prolonged pause. Anything because of El Nino would be a supply side effect. I don't see how that can be reined in by higher interest rates. Higher interest rates come in when the economy is running faster than it can, when there is very good growth, and you want to rein in because too much demand is pushing up prices. We are not exactly in that situation going by what the Reserve Bank is describing. So I don't see a likelihood of a demand-led inflation coming in at this point in time, but never say never. So I think we should go with an assumption of a prolonged pause.
Right, a prolonged pause, that's the assumption by most of our economists and Lata as well. But Lata, going forward, any closing thoughts, anything on the liquidity measures that the RBI has announced? Because we are staring at a liquidity crunch given the fact that the TLTRO ends somewhere in April.
They have stuck with removal of accommodation. Removal of accommodation means what? That liquidity conditions are loose and I am removing the accommodation. If you're removing accommodation, how can you provide liquidity? That will be a contradiction. So at the moment, the Reserve Bank putting in liquidity in a durable way is not on the horizon at all. They may change their stance later, but at the moment, and in any case, I don't think their help is needed for market borrowing or for any such. The debt funds and even the insurance companies have got manna from heaven in the last week of March. I think debt mutual funds have got some 50,000 crores. They haven't seen that kind of money for the last 2-3 years because interest rates are falling. So I think the borrowing program will go very smoothly. There is no reason for the Reserve Bank to intervene now. My big point is for banks. Banks have all their loans tied to repo. Now they can't raise it because the repo has not gone up. At the same time, there is a near-term liquidity tightness. I mean, not very tight, but some banks at least will have to fight for deposits. So my sense is there is going to be a margin issue for some banks. You will have to really quiz a lot of bankers to ask whether at least rising NIMs is over. Whether the NIMs could even get squeezed is the question you should be asking bankers and banking analysts.
Right. Lata, thanks a lot for taking out time and putting things into perspective for us. Let me also go across to Tanvi for a closing comment now. Tanvi, leave us with some closing thoughts as to what you expect the future to look like when it comes to Indian growth as well as, inflation trajectory.
I would say if I look at the future growth, barring the near-term uncertainty which we are seeing, which is a headwind for even India's growth because of tight monetary policy, global growth environment slowing, and volatility which has gone up because of the banking turmoil, I would say largely we would say India is going back gradually towards a 6% handle. So barring an FY24 GDP growth where we are below consensus at 5.5%, we are pretty confident from a 6% kind of handle for India from a 2 to 3 year perspective. I think the lot of external stability risk and the macro stability risk, which were the highlight of last year, especially on the current account deficit and inflation, I think all those have peaked. So that gives a lot of solace to the policymakers that at least they can now start focusing on growth over inflation. The third thing I would highlight is that whether RBI is comfortable with an inflation which is below a 6% band, that gives a lot of policy focus back on growth over inflation. So that are the three things which I would say are the closing comments at this point.
Well, with that, thanks a lot, Tanvi, for taking out time and joining us in our special coverage. But with that, let's also listen into some of the key announcements that were made by the RBI Governor in his policy statement.
Be not slack. Once rate over the medium, one can imagine the magnitude of challenges central banks and other policymakers face in today's world. The Monetary Policy Committee met on 3rd, 5th and 6th April 2023 and assessed the macroeconomic situation and its outlook. It decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting with readiness to act should the situation so warrant. Let me read this sentence again. The Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC with readiness to act should the situation so warrant. Consequently, the standing deposit facility, that is SDF rate, will remain unchanged at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me emphasize that the decision to pause on the repo rate is for this meeting only. I would now like to explain the MPC's rationale for these decisions on the policy rate and the stance. While the recent high frequency indicators suggest some improvement in global economic activity, the outlook is now tempered by additional downside risks from financial stability concerns. Headline inflation is moderating but remains well above the targets of central banks. These developments have led to heightened volatility in global financial markets as reflected in sizable two-way movements in bond yields. Fall in equity markets and the US dollar shedding its gains from its peak of September 2022. Amidst this volatility, the banking and non-banking financial service sectors in India remain healthy and financial markets have evolved in an orderly manner. Economic activity remains resilient and real GDP growth is expected to have been 7% in 22-23. Consumer price inflation, however, has increased since December 2022, driven by price pressures on cereals, milk and fruits. Core inflation remains elevated. Looking ahead, headline inflation is projected to moderate in 2023-24. The monetary policy actions taken since May 2022 are still working through the system. Accordingly, the MPC decided to keep the policy rate unchanged to assess the progress made so far while closely monitoring and evolving the inflation outlook. The MPC will not hesitate to take further action as may be required in its future meetings. To recapitulate the actions taken so far, we have increased the policy repo rate cumulatively by 250 basis points in the last 11 months starting May 22. This was preceded by introduction of the standing deposit facility, that is the SDF, at a rate 40 basis points higher than the fixed rate reverse repo. Thus, the effective rate hike since April last year has been 290 basis points, 290 basis points. These increases have been fully transmitted to the overnight weighted average call money rate, that is WACR, the operating target of monetary policy, which has gone up from daily average of 3.32% in March 22 to 6.52% in March 2023. It is now necessary to evaluate the cumulative impact of these rate hikes. Under these circumstances, we have to be extremely prudent in our actions. We have always been very watchful and have adopted a calibrated and balanced approach and will continue to do so. When we started the rate cut cycle in February 2019 to provide support to growth, the CPI inflation was around 2% and the policy repo rate was 6.5%. Now the policy rate is 6.5%, but inflation is 6.4% as per the February reading. Overall, inflation is above the target, and given its current level, the present policy rate can still be regarded as accommodative. Hence, the MPC decided to remain focused on withdrawal of accommodation. What I now propose to do is to just briefly state about the growth and the inflation scenarios, and I will then try and sum up the broad approach which the monetary policy committee has taken, and I think that will give even greater clarity of what the monetary policy committee is doing. So, let me first take up growth. As stated earlier, India's real gross domestic product, that is GDP, is expected to have recorded a growth of 7% in 2022-23. Hence, economic activity remains resilient. On the supply side, Rabi food grains production is estimated to increase by 6.2% in 2022-23. PMI manufacturing remained robust at 56.4 in March, recording expansion for 21 consecutive months due to favorable domestic demand. Service sector activity exhibited buoyancy. PMI services remained expansion zone at 57.8 in March, driven by favorable demand conditions and new business gains. Aggregate demand conditions were resilient in Q4 of 22-23, even as private consumption showed some signs of slowdown. Urban demand indicators like passenger vehicle sales and credit card spending registered robust growth in February, while consumer durables contracted in January. Rural demand indicators such as consumer non-durables, tractor and two-wheeler sales registered healthy growth. Investment activity exhibited buoyancy on the back of government's thrust on infrastructure spending, high capacity utilization, and revival in corporate investment in certain key sectors. Non-food bank credit rose by 15.4% year-on-year as on March 24th, 2023. The total flow of resources to the commercial sector has increased by 26 lakh crore during 2022-23 as against 19 lakh crore a year ago. Merchandise exports and non-oil, non-gold imports contracted in February. Services exports continued to register robust growth. Supply chains are returning to normalcy globally as well as domestically. Looking ahead, the higher Rabi production has brightened the prospects for agriculture sector and rural demand. The steady growth in contact intensive services should be positive for urban demand. The government's focus on capital expenditure, capacity utilization above long period average, and moderating commodity prices should bolster manufacturing and investment activity. The drag from the net external demand may continue due to increased global headwinds. The protracted geopolitical tensions and global financial market volatility pose downside risks to the outlook. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.5%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6.1%, and Q4 at 5.9%. The risks are evenly balanced. Let me now turn to inflation. The softening in inflation during November-December 2022 turned out transitory, with CPI headline inflation breaching the upper tolerance threshold during January-February 23. A sharp turnaround in food inflation drove the pickup in headline inflation as core inflation remained elevated across a range of goods and services. Looking ahead, the expectation of a record Rabi harvest bodes well for easing of food price pressures. There are already evidence of a correction in wheat prices in March on supply side interventions by the government. The impact of the recent unseasonal rains in some parts of the country, however, needs to be watched. Global commodity prices have moderated significantly from their heightened levels a year ago. As our surveys point out, cost conditions have somewhat eased. Inflation expectations of households have also eased down. On the upside, adverse climatic conditions are a risk to the future inflation trajectory. Milk prices are also likely to remain firm going into the summer season due to tight demand-supply balance and fodder cost pressures. The rising uncertainty in international financial markets and imported inflation pressures need to be monitored. Factors, and assuming an annual average crude price Indian basket of 80 and a normal monsoon, inflation is projected to moderate to 5.2% for 23-24, with Q1 at 5.1%, Q2 at 5.4%, Q3 5.4%, and Q4 at 5.2%. The risks are evenly balanced. Now, let me now summarize what I have said so far. We are living in very volatile times. The sudden announcement of an output cut by the OPEC Plus a few days ago and the resultant jump in crude oil prices is yet another evidence of this volatility. The overall outlook thus remains dynamic and fast evolving. Our monetary policy in the recent period has aimed for a non-disruptive normalization from the pandemic era stimulus measures. Even as monetary policy moved decisively to withdrawal of accommodation, financial conditions evolved in line with the productive requirements of the economy. Growth has since then become broad-based. Inflation has softened from its elevated levels a year ago. However, it still remains above the upper tolerance band. Projections for 2023-24 point to a softening in inflation, though the disinflation is likely to be gradual and protracted given the rigidity of core or underlying inflation pressures. At this stage, we remain watchful of the evolving outlook and the impact of our actions during the past 1 year on the broader real economy. While we have kept the policy rate unchanged, it is important to bear in mind that this decision was taken on the basis of our assessment of the macroeconomic and financial conditions with reference to the information available up to today. Our job is not yet finished, and the war against inflation has to continue. And this has to continue until we see a durable decline in inflation closer to the target. Let me read again. Our job is not yet finished, and the war against inflation has to continue until we see a durable decline in inflation closer to the target. We stand ready to act appropriately and in time. We are confident that we are on the right track to bring down inflation to the target rate over the medium term. As we proceed towards this objective, I recall the wise counsel of Kautilya 2000 years ago, and he said, and his statement was as follows: be not slack
Bridge on MPC outcome, and I'm joined by my senior consulting editor N. Mahalakshmi, and we will be speaking to Rohit Srivastava of India Charts and Pathik Gandotra of Drone Capital. Well, good morning, guys. Good to have you. First of all, I want you all to give us a first take on what has happened with the policy. It was a surprise pause as vis-a-vis expectations of a 25 basis point rate hike. Even though the governor has said that it's a pause for this policy, and it can actually look at another hike in the next policy. But what are your own thoughts? Do you think now is the time when the RBI will take a prolonged pause, given the fact that they expect the inflation to ease going forward?
Rohit, you'll take this.
My take is that while the expectation was for 25 bips, I think if you just watch the central bank action around the world over the last few days, everybody's taken a cue from falling bond yields that we can move towards a pause. You saw Australia do that, you saw Poland do that, and I think there was a case therefore over the last few days that maybe the RBI takes that cue. And bond yields were reflecting it yesterday because they broke below 7.3%. And today's break really sets the course not just for now, but I think for many months to come. The RBI statement itself, of course, has to maintain caution because we are not completely done with inflation cooling off, even though we think that the trajectory for inflation should be lower. So I think that is why they'll maintain caution till they really see the job done. But clearly the bond market is leading the way this time, indicating that interest rates head lower.
Right.
Yeah, so
Rohit, I also want to ask you a question about the realty pack. We are seeing a sharp reaction come in. The realty index is up 2%, even though on a YTD basis it's down somewhere around 8% or so. Do you think now this, this pause will actually give a fillip to some of these realty stocks going forward?
So basically what you're saying is interest rate sensitives. 10 basis
Right.
point drop since yesterday that we have seen is definitely positive for interest rate sensitive sectors. That's a simple takeaway.
Right. Pathik, coming to you. you know, private banks have done far better than PSU banks even this year. But given the fact that deposit rates are hovering around the 7 to 8% mark, do you expect margins to come under pressure in the coming quarters, at least in Q4 and Q1?
No,
But
because actually
before
loan.
going into that, question, let's just stay on a little bit more on yields and what is the future of interest rates.
Yeah.
First of
Okay.
all, what
Fine.
is
So
your take on yields going forward? Are we really have we really hit the bottom, and what is the justification for that? I heard Rohit saying that we might have hit the bottom, and the market is signaling that, but markets could also be wrong.
yeah. So I'll take the
What is
previous
the
question
solid
also. Yeah,
justification for
I
us to be
understand.
taking,
Yeah,
bottoming
yeah.
out
So I'll
at this
take it.
point
I'll
in
take the
time?
previous question also. And I'll reply it together. So we were expecting that the bond yields that the RBI would pause, maybe not this time, but next time. But in concept, if you take a slightly longish term view, interest rates have peaked across the world because after the SVB collapse, I think the US also figured that the impact of the huge interest rate hikes that they have done is getting felt across the economy, and it takes time for it to manifest. And so I think that was a jolt to everyone. And also, since the oil prices started correcting six months before today, that was the leading indicator of inflation across the world, any which ways. Despite the war still going on, oil prices started correcting. So my point is that this was supposed to happen. It would have happened this policy or next policy, which is why the reaction, although is positive, but it's not like so outlandishly positive that you've been really surprised. So the point, but the main issue here is that inflation, the impact of high bond yields or high interest rates on the economies across the world is getting felt, and I think the central bankers know it. And inflation across the world in different countries is coming down at a different pace. And so I think no one can afford a rate hike anymore. You are probably at the last leg of rate hikes, if at all there are any. Yesterday, I think recently when the Reserve Bank of Australia paused. So that's the point I'm saying is that yeah, to answer your question, Mahalakshmi, I think yields have peaked, not bottom. They've peaked,
Yeah.
from here on, you'll see, I
Right.
think, a prolonged period of stable yields, and then they'll start.
સૌનું સ્વાગત છે આ સપ્તાહના ટેક ગુરુમાં અને હું છું નીરજ કંસારા અને આ અઠવાડિયે આપણે વાત કરવાના છીએ બે ફોનના.
You're going to have steady inflation, steady declining inflation, which will just offer the central banks enough comfort to hold on to rates. That's what's going to happen. And now on your question of private banks versus PSU banks, if you've been in discussion with me, I am always a proponent of private banks over PSU banks anytime. I don't think PSU banks have any competitive advantage whatsoever. So I am of that view. One should always buy private banks only. They will take market share. They will gain. You can have cyclical periods of times when there's panic in the world, panic in the Indian markets or in the depositors. So PSU banks do get access to deposits during that time. But eventually, I think private banks will be a better bet to be. And on deposit rates, the point is that since deposit growth has been very slow, if you notice, and loan growth has been strong, and so there's a case for banks to hike deposit rates, and that would have hit margins. But if you see the recent thing that's happened with the RBI, with the government, they've increased tax on debt funds. That's given a fillip to deposits. So what's going to happen is banks may not have to necessarily increase deposit rates to get deposits. And so, since the loan rates have gone up, margins have, I think, flat to upward bias rather than a downward bias, is what I think.
Right. Patrick, since you were talking about private banks, are you overweight on any of these counters like Axis Bank, ICICI Bank, or HDFC Bank? Which one would you
All
place
of
your
them.
bet in the current?
They are all very good. They're all, because you are in a cycle where now the economy will again pick up steam. You'll see loan growth rebound. You'll see government is spending on infrastructure. That's a basic driver of economic growth. And India's capex cycle is also big enough, as is now a common knowledge. So you're going to have that. That's also going to drive growth. And finally, now with interest rates peaking and elections around the corner, over the next 6 to 12 months, you're going to see consumer demand also rebound. So everything is pointing in direction of growth coming back, interest rates stable, and so earnings doing very well.
I think, what kind of probability will you assign to markets being wrong and for us to surpass yields from where we are seeing? because whatever we may say today, the data does not corroborate. Whether we look at GDP data, unemployment data, none of it really shows a very strong signal of of recession yet. We've been talking about a potential recession for more than 1 year now, but we haven't seen signs of it yet. So, what is the possibility that this strength continues for the next 2 quarters? Because the central banks are today just saying that, okay, we've come this far, we need to pause and see what is the outcome, and then we will take a call on what should be the future trajectory.
So, the interest rate hikes play through the economy very, very slowly. And if you see, weakness has started showing. It's not as if it's not. If you see even US economic data, because that's where the interest rates have increased the maximum and the sharpest. But it's already started showing. You'll see in employment data showing slight signs of weakness. I agree with you. It's not really crashed. So my point here is that for the next 2 quarters at least, nothing drastic is going to happen on the economy, and you might just about survive. You might survive through just a minor dip in the economic growth, and then to stabilize. So that's why I was saying that I don't think interest rates are coming down majorly, because that requires serious weakness to happen. So there's we talked to a lot of companies in the US also. What happens is that on the companies are fearing, the companies boards, the companies managements, they fear there's going to be a recession, but on the ground nothing is really going that bad. On the ground things are still pretty robust, or at least tagging along. So the best case scenario for the world is that you go through a period of flat interest rates for years to come, and then growth slightly at a lower level slightly rebounds, and in that environment emerging economies like India do very well.
Sure. Rohit, the governor has increased the forecast for GDP despite having seen so many rate hikes, and those hikes have not really played into the system as much. What gives?
So to some extent, I think you have to look at the government really spending more. I think part of what the budget ended up doing is a lot more spending on capex. That's one of the big items, and that 30% increase in spending is going to play an important role in keeping economic activity going, even as the world is facing headwinds, dual headwinds. There's also something which sort of is rebalancing at the global in the global space, and which is the China reopening, which I think is sort of underappreciated, but it is slowly kicking in. If you simply look at things like Chinese PMIs and all rising, you can actually see that change, which will sort of support global growth even as the US slows down. Another factor will actually be rates themselves, because I think, and we've actually seen something very new in this interest rate cycle, which is probably not seen before, which is the differential between Indian and US interest rates really narrow down. This has probably never happened before. So the big risk, if I went back to December, I was thinking the markets were rather bearish, because I thought rates in India would break out beyond, say, 7.7%. which is usually a risk zone, because the moment you cross 8%, we've seen many market corrections in the past. What ended up happening though is rates in India stabilized from there and actually started to head lower, and now we are breaking the lower bound. And that is sort of indicating that interest rates in India actually would head much lower on a multi-year basis. So will the differential between India and US on the rate side really remain this way? Probably the answer is yes, and which means that lower rates in India, because we have a lot more room to cut, would actually be stimulative in its own way, for markets, for growth. So that I think there are multiple factors that can come into play, and that is probably why we are able to keep projections of growth higher. I mean, even if you go back to 2008, India has a very different economy, and I had this discussion that time with Vetri. I was thinking that, would you actually see growth in India turn negative after the 2008-9 crisis? And he said, the way we are structured, we rarely fall below 5% growth. And even during the entire crisis of 2009, we didn't see less than a 7% GDP growth. So this is just how we are structured. So we are sort of, when we say we are at 5% growth, we actually saying that we are at the bottom end of our growth curve.
Rohit, I have this point on differential. Pratik, how much more room to go? I mean, further compression in this differential really possible? Is that a big risk? Because if you were to see a scenario where the US Fed has to hike rates more, but there is no compulsive reason for us to do so, except that the differential continues to narrow.
I don't think it will. I don't think it will. I think US is fundamentally a low inflation economy. This is a cyclical. It's a cyclical thing. I mean, it's all there. It's all their historic excesses which have led to this inflation. But eventually, I think US interest rates will also head lower. And I think you are actually, I mean, it's very difficult to predict 50, 100 basis points. But structurally, if you ask me over the next 3 years, will the inflation differential widen with interest rate differential widen between India and US? Yeah, it will. And although I also think that our rates will fall a bit, but US rates will fall more, is what I think. So there, the whole thing is structured. See, it's a extremely market driven economy. There's so much of money chasing any trend that the moment they figure out that rates are going to fall, they'll take it to its extreme. So which is why I think the rates in the US, you have actually quite reached the peak of it, the end of it. I mean, this is the narrowest differential that you can be, is what I would tend to think.
Fair enough.
Right. I wanted to get in a question to Rohit on some of these FMCG companies like HUL, Dabur, Marico. Rural demand has been under pressure, but given the fact that the RBI governor has scaled down his inflation estimates for FY24, do you think now that the rural demand may fast track going forward, because there has been some amount of green shoots in the Q4 updates that we've seen from some of these companies?
See, the way I look at FMCG as a whole, and this is slightly more longer term, apart from, if the economy grows, what you get consumption, all that is argument is fine. But when we actually look at it from an investment and cyclical perspective, we've actually seen performance of, defensive sectors like FMCG do really well for a period of like 5 to 10 years. And then we've actually seen them significantly underperform when other parts of the economy start to grow. So this can be mapped all the way back to the 1990s. We had strong growth in FMCG. Stocks were essentially the outperforming sector of the market apart from IT all the way to 2000. But between 2000 and 2010, everything else did well, whether it's infrastructure, capital goods, metals, and all the economy related core industries. Again, you've seen the same pattern through the 2010 to 2020s. You've seen FMCG sort of outperform and become extremely valued as a sector. While they may not draw down that much, my sense is compared to other sectors, they will tend to underperform. I wouldn't want to be in those sectors compared to if I have the option, I would go to, again, the same, which is capital goods, metals, cyclicals, those kind of core sector industries where you're actually going to see a cyclical rebound. We've seen one round of that, I think, in 2021. The correction we've seen last year essentially is a pause in that direction because of this rising rate environment. But I think that entire trend will, kickstart all over again in the coming year, and which is where I would actually want to allocate away from the FMCG sector.
Sure. Prateek, one question on banks. Nandita already asked you about which banks are you bullish on, and I know that you hold this view that private banks are much superior. Public sector banks don't have a future, and therefore they have to be ignored. But within the private pack today, compared to a few years ago, the differential in valuation amongst the big three, for example, ICICI, HDFC, even an Axis Bank, the differential is very little. Even a couple of years, 3-4 years ago, the differential between these banks was really wide. So it sort of made a case. You could make a valuation case for a bank. Of course, there was always risk by way of NPAs, which HDFC did not have. But today, they're all, in terms of asset quality, I don't think there are any big surprises anymore. So how do you play this back? Would you choose one over the other? Or is it just a portfolio bet you would tend to take? How do you play the private sector portfolio, bank's portfolio?
I cannot comment on stock specific. I mean, it gets a bit tough. So I will not speak on an individual stock. But I agree with you in concept. The valuation differential has narrowed. So I would pick the best quality one to be able to ride this thing. I think all the three of them are pretty good. I mean, they've all. it's I mean I can't specifically comment on a particular stock, but I think if you take as a pack, that whole pack will outperform. That whole pack will outperform. And like you rightly said, you have just completed one whole asset quality cycle. So from here on, you have to create more NPAs once, but that NPAs never get created during the beginning of the cycle. They get created towards the end. So once you will first go through normal lending, then high growth, and then there'll be a chase for growth. It's the same thing every year and across the world in every bank. So you are the initial phase of the credit growth cycle. So your NPAs are still some time away. I'd like to make one more point here. I think NBFCs are a very good place to be in because lot of the ones which are where there's growth, in environment of stable interest rates, I think NBFCs also do very well. And so people like say as a pack, I think microfinance companies will do very well. I think because that's another segment where the whole credit cycle has played out completely, and now you're going to get into a situation where NPAs have shrunk and growth is returning, and at least those companies have an advantage over banks in terms of credit delivery. And so I think that's a place which will do very well. Also, say housing finance companies should do well. So I think one should also have a reasonable allocation towards very high quality NBFCs during this cycle.
So, what is your take on the biggest NBFC of them all, which is the most richly valued outlier in that pack? Obviously, every year in the past few years, we've suspected that growth will slow down, and that hasn't happened. Last year was an exception, but again, this quarter, update seems to be quite positive.
It become very large. It become very large now to do those kind of growth rates. So obviously, stock performance will become more steady than it was in the past. But I think till they really screw up on asset quality, I think it should be fine. So it's obviously a big portfolio bet for people. I mean, it's a kind of must own stock in fund portfolios. So that kind of thing. But for us and for people who are investors, I mean, it's a done story. Ho gaya. To use
in fact, on the contrary, I was saying that if you were to see other banks buck up in terms of growth, and you have such a huge differential in terms of valuation, will there be more derating?
So I think the derating will happen
also,
if
the
they choose to become a
narrative that is building in terms of disruption from Jio is also not going to be helping.
Yeah, okay. The Jio can disrupt everything. It tries to disrupt everything. I mean, I've learned this. Let it disrupt, then we'll see. But that's not the main point. I think the main point with that NBFC is if it becomes a bank, then it'll get derated. That's my view. Because as a bank, you can't enjoy those valuations. If you choose to become a bank, then there'll be a massive derating, is what I think. If you choose to remain an NBFC, you can still.
Why is that? On the contrary, I mean, I would think that your cost of capital can come down even more, margins can become better. Why would you think otherwise?
Because ROEs shrink always. Banks cannot make 30% ROE. They can't. They just can't. 20%. It's the way a bank is constituted. You can't make a 30% ROE. You just can't.
Because of the functions of priority.
Yeah. Yes, correct. So and because you have to do all other kinds of lending as well. Yeah, you're right. And so a consumer-only bank, I've not seen one. And so I think the whole thing is that you will eventually, and then there'll be comparisons with HDFC Bank or whatever. All those kind of comparisons will start happening. So then I think, I mean, if on one side it'll lend more stability if you become a bank. So then that becomes I buy the case as to why one would like to become a bank, but that gives a longer term business stability. But valuations will derate. I think nearly for sure once you decide to become a bank. That's what I think.
So it will be a shareholder unfriendly move to become a bank?
Depends upon the tenure that you're looking at. Because long term, very, very long term, you are safe from the risk because an NBFC is also always susceptible to risk in a crisis. A bank is not that susceptible. So, your business model will become less volatile, but there'll be a one-time derating. That will happen, is what I think. It's very contrary to what other people think. This is my view.
No, this is an interesting, contrarian view, absolutely. Rohit, how do the technicals look for the entire banking universe? We had a fantastic year last year, but in the last month or so, it's not been great news for banks. How do you look at that back going into 1 month, 1 year?
Yeah, so I think banking is a very important sector, and we're always watching whether it's outperforming relative to the Nifty. If we do a very simple comparison from the bottom when the Nifty hit 15,200 and it rallied into December, and then we pulled back, the Nifty's actually done a slightly more than 50% retracement of that entire advance, whereas Bank Nifty's actually done only 38%. And so, by that very nature, it sort of outperforms the Nifty itself. So we actually seen strength overall, even though they've been down for the recent period. Overall, the banking sector has actually been showing relative strength. And within the banking pack, while we don't really give advice, but I'll still mention a particular stock in terms of within the private banks, because one simple way that we analyze is we actually look at what is relatively performing, and we always think of, okay, is it HDFC, is it ICICI? And actually, over the last year, you see ICICI Bank performing much better than some of the others in the private sector banks. So it's actually showing signs of coming out of a long period where it was probably on a relative underperformance phase, uh, and that means something is probably meaningfully changed over there. So I sense that if I had to pick something within private banks, I would actually go with one which is showing the best performance over the recent period, and that seems to be standing out.
Rohit, I want to come in I want to ask you one question on the auto pack. Most of these four-wheelers have clocked in record sales in FY23, even though Maruti has said that, to maintain that run rate of 20% will be difficult in FY24. So, and of course, there is the threat of El Nino that looms large over some of these two-wheelers. So, would you say four-wheelers are better poised when it comes to, investment opportunities compared to, say, two-wheelers now?
Well, there is relative strength there for sure. If we actually look at the stocks, the four-wheeler stocks have held out a little better. The two-wheeler stocks have already, but have also taken a big hit. So the awkward situation would be, do you buy something that has fallen a lot, or do you buy something that is held out better? Uh, Sometimes so if you're running a performance based portfolio, you'll always end up chasing what ends up doing better. So there's something known as momentum investing, and in that sense I think the four wheelers are still standing out much more than the two wheelers. So unless that performance really changes, we may not even switch gears from one to the other.
Rohit, today is big banks day, so more on banks and financials. How does Bajaj Finance look on the chart?
So I think after a pretty prolonged hit, it's actually back to its 40-month average, and it's not really broken that. In that sense, longer term, you're at a very very important support level, which I think is holding so far, which is a good sign. Probably also means that the risk reward is favorable given how close you are to the bottom end of the entire trading range. So I would tend to think positive for the stock given where it is placed in a larger trading range.
How about SBI, Rohit?
So SBI, out of all the PSU banks, is probably the only one that hit an all-time high in the recent period, which sort of set stage for it breaking out of what was almost a 6-year, 8-year trading range. So it started to trade outside that, which is actually good. There also, I think it's seen a good consolidation on weekly charts, probably holding only slightly below the 40-week. Maybe it's around a say 50% retracement of the gains it had made between mid of last year to the end of the year, which is a fair point. So if you've given a good retracement to those gains, I think that sets up good levels from an entry perspective.
All right, I would like to come in here. I think the presser is just about to start. So I would like to thank Patik and Rohit and ML to take out time and have this a very special discussion on MPC outcome day. But we will be cutting across to the RBI post policy press conference pretty soon. So stay tuned to Moneycontrol.
Thank you.
Thank you.
Okay, let the photographs be taken. So, bit of a surprise for the market. Yeah, now take the photographs. Thank you. Thank you.
Hello and welcome to the first bi-monthly monetary policy, post-monetary policy press conference of the fiscal year 2023-24. We are glad to have with us a governor, honorable governor, respected deputy governors. Before we go ahead with the press conference, sir, with your permission, we'll request you to say some opening remarks and then we'll go on with the press conference.
Okay. Good afternoon. Good to have all of you here, as in the previous occasions also. I'd like to make 4 points. First, if I have to characterize today's monetary policy in just one line, I would say as follows. It's a pause, not a pivot. Number 2, there has been an effective rate increase of 290 basis points over the last 1 year, including the SDF 40 basis points rate increase. And this 290 basis points increase, in fact, has translated to a monetary policy transmission by way of increase in the overnight call rates. I have given the numbers in my statement. The overnight call rates have gone up from the daily average in March last year to the daily average in March this year by 320 basis points. I have given the numbers. They were 3.32 last year in March. This year in March, the daily average was 6.52. So therefore, the effective increase has been in the order of 320 basis points. It is therefore now necessary to assess the cumulative impact of our actions taken so far. That's the second point I wanted to make. The third point is that the MPC remains watchful and will not hesitate to take further action in its future meetings as may be necessary. So the job is not yet finished. 4, given that there is overall macroeconomic and financial stability, our priority continues to be price stability. Thank you.
Thank you, sir, for those opening remarks. I'll begin the press conference by inviting Mr. Ankur Mishra from ET Now to ask his question.
Thank you, Governor. Sir, with the emphasis which you have given on the pause, if I want to understand and take away from that in cricketing parlance, is it a pause like you're watching a good over, you want to continue watching it and then play the shot later? Or this does not leave out the possibility that you will continue to make strokes if it is needed later?
To use a cricketing parlance, it will depend on each ball. On a more serious note, we are watchful of how it is playing out. Monetary policy, as you know, is always forward-looking. We are watchful of the impact of the action taken so far. There are so many other external developments also taking place, both with regard to inflation, with regard to growth, and so many other things. So we will be watchful of the overall situation. And monetary policy being forward-looking, we will take further action whenever we think appropriate.
So another question I wanted to ask, just one on SVB financial crisis. You have already given a statement earlier that banks need to be watchful. But in Indian condition, as a regulator, do you feel that such crisis cannot happen, at least in India?
I think I'll pass it on.
Thank you, Governor. I think Governor said in his statement that as of now, the Indian banking system remains sound and healthy, with strong capital and liquidity position, improving asset quality, better provisioning coverage, along with the improved profitability. Governor said in his statement also it's an evolving position, and we are living in an uncertain period. But one thing I would like to add, that the prudential regulation are across the commercial banks are uniformly applied, whether it is SLR, CRR, LCR, NSFR, investment fluctuation reserve, and the stress testing. So there is no differentiation just because of the sheer size of the asset of the bank. Thank you.
Thank you, sirs. I'll move on to Mr. Laltendu Mishra from The Hindu.
Thank you, Governor, for taking my question. Sir, the RBI is using data to decide whether to increase rates or take a pause. You have taken a pause, it's a great thing. And as we all know, increasing interest rate continuously has a risk for financial stability, and that is playing out in the US. So my question is to you, sir, is that at what point in terms of data will the RBI concede that using interest rate alone to tackle inflation has its own limits? Thank you, sir.
I would request Dr. Patra to take that.
First of all, in the fight against inflation, interest rates alone have not been used. They have been used in conjunction with supply-side measures because alongside demand pressures, there have been multiple shocks, overlapping shocks on the supply side. So first of all, that's the fact. Then we have an assignment where regulatory macroprudential policies are assigned to financial stability. So they are separate tools which ensure that banks are sufficiently buffered against the kind of shocks that you saw.
Thank you, sir. I'll move on to Ms. Lata Venkatesh from CNBC TV 18.
Thank you, Yogesh. Governor, I have just a set of questions on inflation. Now, if inflation proceeds as per the Reserve Bank's statement, then will you still have to hike, or is it a pause? And going on to, if that is the assumption, 5.2 is the Q4 inflation, so your real positive rate becomes 130 basis. Is that the comfort zone? If it is, then for FY 24-25, the MPR says your range is between 4.7 and 4.4. So technically, in a few months, you should be cutting, because otherwise you will be 200 basis points real rates. Is that the way we should understand it? But first, if it evolves as per trajectory, is there no hike needed?
The average inflation we have given for the current year is 5.2%, and our target is 4%. Given the confluence of factors which prevail today, I have said it in my statement also, given the confluence of factors which prevail as of today, we have taken this policy decision in today's meeting. Our target is 4%, and if you see the monetary policy's withdrawal of accommodation, it says to progressively align with the target. So therefore, we have to always keep in mind that 4% is the target, and we will work towards that. Beyond that, it would not be possible for me, with so many uncertainties remaining, it's not possible for me to make certain assumptions and say that if these assumptions work out, I will act accordingly, because there may be so many other developments also happening. And in an extremely uncertain environment like the one we have today, I mean, just last week, you had the OPEC Plus cut, and I have referred to it, with so many other developments taking all over. And given the, the heightened uncertainty, I would not like to commit myself to, if this happens, I will do this. I would rather wait, and as in a game of chess, we keep on thinking about our forward moves, and we will act when the time arises. Would you like to supplement anything?
Just a word on...
No, I think...
Yes, sure, please.
Yeah, just to supplement. Parliament, we had this conversation in the last meeting, where you raised a similar question. I would like to add to Governor's remarks by saying that relative to last meeting, we are much better off. If you recall, at that time we were 0.9 percentage points above the 4 quarters ahead rate. Today we are 1.3 percentage points. So economic theory says that if you are a disinflationary central bank, you should react more than proportionally to the change in inflation. And we have achieved that in this meeting.
Okay, so just a word on growth. Maybe we can come back later. I'll just move on to others. I'll invite Mr. Ben Jose from PTI to ask his question.
Switch off the mic, please.
Good morning, Governor. Ben here. While everybody has have a lower forecast for growth, you have increased the growth forecast by 10 basis points. What is the rationale for that? RBI and there have been calls by certain analysts that RBI have to decouple from the US Fed when it comes to monetary policy. Is this the beginning of that decoupling? Beginning of decoupling from the Fed policy rate?
No, with regard to coupling with the US Fed, it has never been so. For some reason, sections of the market has been seeing it that way, and repeatedly I have been stressing that our monetary policy is determined primarily by domestic factors. So therefore, we were never really coupled with the US Fed action. And it's for you to really interpret. With regard to the growth numbers, I think let Dr. Patra reply to that.
So you should see the forecast as compared with the estimated actual for 22-23. So we are actually downgrading our growth outlook for 23-24 by 50 basis points, from 7% to 6.5. What you are, I think, alluding to
6.4.
Yeah, 6.4 to 6.5. One important change is that there is a change in the oil price assumption from 90 to 85.
Okay. Thanks. Good. Thank you, sirs. I'll move on to Ms. Chloe Cornish from Financial Times.
Thanks, Yogesh. Some bankers are considering the 6.5% will be the terminal rate, despite what you said about the willingness to take further action. I'm just wondering what you would say to them. I mean, is it the terminal rate, or should they really understand that you're serious about taking further action as needed?
I think everyone should take seriously what I have said. And I just now said that it's a pause, not a pivot. And we have said that the MPC stands ready to act should the situation so warrant in the future meetings. So I think banks or anybody else, they can draw their own inferences, but I think it will be better. It will be desirable that they sort of take our words seriously, and I think they do take our words seriously, and accordingly they price in their future actions.
Thank you, sir. I'll move on to Mr. Govardhan Rangan from Economic Times to ask his question.
So good afternoon, Governor. You mentioned about the OPEC decision that has actually caused the volatility. But if you look at that statement, you have actually decreased the crude oil price assumption from what it was in the past. Plus, your action and the forecast, like for the first time you used the phrase that for this meeting only, which I don't think which you have ever used in the past. So your forecast and your actions are kind of appears to be a bit contradictory or contrasting. How does one read all this projection which takes the inflation down, but at the same time saying that this is not a pause? In the sense we are not going to stop here. How does it add up?
You see, $85 per barrel is the average for the whole year. Today the prices have gone up to 85, and they are now, I think morning they were just little below $85 per barrel. But this assumption is for the whole year, and the year has just started. So therefore we have to wait and see, and we have reasons to believe that it will be around the assumption which we have made, that is at $85. And what is the other one you said?
So about that, for this meeting only, you use the phrase which
we want to emphasize and drive home the point. what I said just now, that it is a pause in this meeting. Don't take it as a pause for several meetings in the future or for all times to come. Take it as a pause only for this meeting.
But all your forecasts, whether it is inflation or the real positive rates, growth forecast, so everything points to a fact that it could be a bit longer than this one meeting alone.
Let us see. I think the future will decide. Monetary policy is forward-looking, as I said. So we will wait for we will make our analysis about the evolving outlook and take a decision. Beyond that, I don't think I would like to tie myself up and tie myself down to any specific, commitments.
Thank you, sir. I'll move on to Ms. Swati Khandelwal from Zee Business News.
सबसे पहले जो आपने कहा वो बहुत क्लियरली स्टैब्लिश कर रहा है कि आरबीआई विल बी वॉचफुल, आप सब कुछ कॉशियस होकर टाइमली इंटरवीन करेंगे जब ज़रूरत होगी. लेकिन आपने ये भी एडमिट किया है दैट ग्लोबल चैलेंजेस आर प्रीटी बिग और उसके चलते हम ओपेक में देख रहे हैं अब कटिंग प्रोडक्शन इज बिगिनिंग अगेन. आपने जीडीपी फोरकास्ट ग्रोथ को बढ़ाया है डिस्पाइट दैट. तो आर यू ओवर ऑप्टिमिस्टिक अबाउट दिस, एंड अगर ये चैलेंजेस रहेंगे तो फिर ये टारगेट कैसे मीट होगा सर?
I mean, we have given our forecasts. It's for you to interpret whether we are over-optimistic, but we are always prudent in our approach. As a central bank, the Reserve Bank is always prudent and always on the conservative side, like any other central bank. And at this point of time, we do believe that these are likely numbers, and we have come out with that. And the underlying, the growth momentum also at the moment, I have explained in my statement that the, the high frequency indicators and the economic activity continues to be resilient. And as the Deputy Governor just mentioned, current year growth is 7%. So next year we are reducing it to 7.5%. Sorry, 6.5%. From 7 we are reducing it to 6.5. So therefore, where is the optimism?
Thank you, sir. I'll now move on to Mr. Mayur.
But overall, we are optimistic about the Indian economy.
Sure, sir. Thank you, sir. I'll move on to Mr. Mayur Shetty from Times of India.
Thanks, sir. Governor, you mentioned that the cumulative rate hike works out to 6.9%, including the SDF. But the SDF operates only on one end of the corridor. Sorry, you said 2.9% rate hike. And what happens when the rates move outside the corridor, and what would be the relevance of the reverse repo rate? And so one more question, if I may. Recently, there has been a lot of news on countries moving away from the dollar for trade. So I was wondering if you could give an update on India's move to internationalize the rupee for trade.
I think the first part of the question, Dr. Patra, you can take. And the second part on rupee, DG Ravi Shankar can take.
So if you recall, during the pandemic, RBI managed liquidity in such a way that the call money rate, which is the operating target of monetary policy, hovered around the reverse repo rate. Okay, so that was like close to 335. So the lift of the rate has to start from 335. So the first stage of lift was to take it to the SDF rate, which was placed 40 basis points above the fixed rate reverse repo. That's why Governor mentioned not just the 250 that is done the repo rate, but the 40 which was done without the repo rate by just doing the SDF. That's why 290. And yes, rates need not always fall within the corridor. They sometimes fall out of the corridor depending on liquidity conditions. But the idea is to keep it as close, as aligned to the corridor as possible.
On the interest, on the rupee internationalization, we are seeing that interest. Volumes are not picking up as much, but I think those are teething issues that needed to be worked out. So the number of countries from which interest is coming is gradually increasing. The number of banks with whom accounts are opened are gradually increasing. The number of overseas banks who are opening those accounts are gradually increasing. So, the initial processes are on, they are encouraging, but this is, as all of you would realize, a long-term objective, and we have to build towards that. Thank you. Beg your pardon?
People have actually exported and imported on rupee.
some transactions have happened, definitely, yes.
You see, the stakeholders on either side, they're getting adjusted to it. It's a completely a new paradigm for stakeholders, for importers and exporters from both sides, for banks on both sides meaning India and whichever is the country at the other end. So they're getting used to it. So it is something which we expect will improve steadily.
If I may just add, we are seeing a lot of official interest in this. Other central banks, other governments taking note of this and trying to talk and find out and explore the opportunities as well.
Thank you, sir. I'll move on to Mr. Anup Roy from the Bloomberg.
Thank you, sir. Sir, you have said that this is a pause, not a pivot. Why not give, a more longer duration guidance kind of thing, and what will trigger the pivot? And also, sir, is your pause this time based on your internal assessment of CPI, since there has been concerns about overestimation of CPI in the last two prints?
No, nothing like that. The decision is mainly premised upon the fact that we have done so much in the last 12 months. We started our SDF action last year in April, and now we are in April. The rate action, repo rate came in May, and now we are in April. So it's just about a year. So we felt that it's now time to assess the cumulative impact of the actions which we have taken so far. And with regard to, the other part, giving guidance, if you recall in my minutes of the monetary policy meeting, I think it was last time, I had said that in an extremely uncertain environment that we are facing, it is not prudent to give specific forward guidance with regard to rates.
Thank you, sir. I'll
Sir, about that CPI thing, sorry.
Okay. CPI?
Is your pause based on the CPI, your internal assessment of CPI?
CPI is the domain of NSO. We have brought to public sensitivity the issues therein, that if there is no price, there should be no, it should not be an issue of how missing, like when mangoes go out of season. There is no mango price quoted. So that should have been the approach. That's all we are saying. We are not going to tamper with CPI or assume that it will change methodology or anything like that. We take it as it is.
Thank you, sirs. Mr. Manojit Saha from Business Standard.
Thank you. You have said that on the stance, because there is a lot of discussion on the stance in the market also. You said the overall inflation is above the target, and given the current level, the present policy rate can be still be regarded as accommodative. Does that mean that until and unless inflation comes to 4%, there is no question of changing the stance to neutral? Because neutral stance could be interpreted as a dovish signal. That is one. The second is the inflation, domestic inflation depends on the pump prices. Does it give you the satisfaction that since pump prices are not responsive to the crude prices of 85 or 90, so a sharp increase from 85 to 90 to 95, even 100, the pump prices may not change because it has not changed when it was 70. So does that give you the comfort that even if there is a shock, that your inflation projections will not change much?
You take that.
So just to answer your question in specific terms, this stance is valid up to 10 a.m. June 8, 2023. At that time, the governor will give you the results of our review of the whole situation, including forward-looking indicators. What was your second question?
The
pump price. Yeah, pump price. Yeah.
Pump prices.
As you know, some time ago, the government decided to link pump prices with international prices. Okay, but that mechanism is now not in operation. So giving you this sense gives you the sense of the under-recovery of oil marketing companies, the likely hidden inflation, which can surface if it is aligned again. But it's just to give the public that awareness that there is this difference there.
And just to supplement one more point, when you make a certain assumption about the crude oil price, it basically reflects that your import bill for oil will go down, and consequently oil import in value terms will go down. So to that extent, the net exports also get impacted. And net exports, you know, is an important component of calculating our GDP growth. So therefore, we do take, you know, we make certain assumptions about the crude oil prices.
Thank you, sirs. Before I invite the next participant to ask question, request limit yourself to one question, and if you have time, we will go for another. So I'll invite Anushka Kayastha from Hindu Business Line to ask a question.
Mike.
Good afternoon. The RBI has been asking banks to make additional provisions for top exposures. I wanted to understand, rather than leaving it at the discretion of banks, are you possibly considering a provisioning buffer to ensure there's an adequate and uniform provision buffer that banks have, especially given the transition to ECL? And a second quick question, if you'll allow me. The proposal for pre-sanctioned credit lines on UPI is very similar to the BNPL model. Is the RBI warming up to the model, and how will integrating it with the UPI network sort of help avoid the issues of the past? Thank you.
Okay.
No, I think provisioning, banks are required to make provisions for expected losses, and for the standard assets, they are required to make additional provisioning as based on their own ability to make provisions for standard assets. So that is something which has been already conveyed to them, and there is no change from what we have prescribed on that particular issue. As regards the BNPL issue or the pre-sanction, I think the guidelines is very clear. It is actually supposed to be a sanctioned limit into the account, and thereafter the transfer will take place. There's no real linkage to the BNPL concept as it stands today.
See, it's a pre-sanctioned credit line. That means the credit line has been sanctioned by the bank, and the customer can now operate it through the UPI. That's all that we have said. Ravi Shankar, you want to add something?
Nothing said, but I mean, that is the clarity. You know, BNPL is just one type of transaction you're thinking about. Think widely, think of UPI, which currently, you know, involves transactions between deposit accounts or wallets, will now expand further to accounts on credit, you know, on credit lines given by banks. So in a sense, you can actually, you know, reduce the number of cards that you carry and do those transactions on UPI rails. So it's more than just what you mentioned.
I think the discussions we can, you know, have it in the offline mode. Yeah.
Thank you, sirs. I'll move on to Mr. Piyush Shukla from Financial Express.
Good afternoon, Governor sir. Thank you, Yogesh, for taking the question. I actually wanted to talk to you a little bit about AT1 bonds. A lot of AT1 bonds have been presently issued by PSU banks, and after the Credit Suisse crisis, again there was a debate on the sustainability of such instruments. So are we looking to provide some sort of feedback to lenders, especially the private ones, on their exposure to such bonds, number one? And if you could also tell us a little bit on the approach, Deputy Governor recently spoke about SRO being formed for fintechs. So what is the, I believe FACE has also come up with a proposal to the RBI for creating a SRO for fintechs. Can you just give us a guidance as to what is the progress on that? Thank you.
First question was? The AT1 bonds ecosystem in India remains quite robust, quite stable, and it is a part of the Basel regulations, and we have adopted that in our country also. And there is nothing more really I would like to say with regard to AT1. When the banks market AT1 bonds, the terms and conditions are given out, and the investors are expected to read the terms and conditions. The investors do know, and if you see, by and large, the large number of investors are basically high net worth individuals. And it's a part of the Basel regulation, so we have adopted it, and there is nothing more that I would like to add on the AT1 bonds. With regard to the SRO part, individual application, if it has come, I cannot comment on that. You see, as a regulator, we also, have been this is not the first time we have talked about, SRO facility. We expect the sector itself, the regulated entities themselves, to take certain ownership and to decide certain micro aspects of going about their business. There are certain things which we prescribe on a regulatory level, at the macro level. At the micro level, we would like the SROs to play a more proactive role. Would you like to add anything, DG Rajeshwar Rao?
No, nothing right now, sir. No, I think Governor has covered it, so I don't think.
Yeah.
Thank you, sirs. I'll move on to Mr. Pankaj Aher from The Informist.
Thank you. Governor, sir, with the MPC taking a pause on rate hikes, do we now see the RBI's monetary policy playing out more through the liquidity channel? That is one. And relatedly, 5.3 prediction of inflation, which is there in the public domain now, does the RBI somewhere fear that perhaps core will align to headline rather than the other way around? Sorry, will headline align to core rather than the other way around? Core has been stubborn for quite some time and seems to be driven more by supply side as...
No, our decision is until the next meeting. So that's standard practice among central banks everywhere. So you will hear our review then. As far as core and headline are concerned, we also have done a lot of research, and we find that actually headline aligns to core over a period of time. But it depends on specific circumstances. Like if there is abundant liquidity, headline aligns with core. But if there is a liquidity shortage, then it happens the other way around. Our sense is that both will moderate towards the 4% target.
Would you like to give a time frame for that? Broadly.
Until the next meeting.
Thank you, sir. I'll move on to Mr. Hitesh Vyas from the Indian Express.
Hi, sir. Good afternoon. Just wanted to check about new umbrella entity. Last February, you had said that evaluation process was on, but there has been no announcement. Just want to know why is there a delay in granting the license?
Yeah, we have had a look at the applications. You see, the objective was to introduce, through the new umbrella entity mechanism, introduce some innovative infrastructural value add facility into the system, because our digital ecosystem, as you know, is already, quite active, quite innovative. We just wanted to bring in new ideas. We did not want something which is either incremental or a substitute of existing ideas or technologies. Now, of the proposals that we have received, we did not see, we did not quite see any innovative or infrastructural solution that had come up. So, so that's where it lies at this point.
Thank you, sir. I'll invite Mr. Sachin Kumar from New Indian Express to ask his question.
Hi, sir. Good morning. You have mentioned in your speech that RBI is looking for a durable decline in inflation. So if you can please elaborate on how much fall in inflation will qualify as durable.
You see, durable means that it has to be a sustainable decline, not that one-off in 1 or 2 months it goes down and again it goes up. So durable means on a sustained basis inflation should go down and progressively align with the target. These are the exact words which we have used. So we will wait, we will see how it moves towards the target of 4%. Idea is to take it closer to the 4% target.
Right, thanks.
Thank you, sir. I'll move to Mr. Shishir Shelar from Doordarshan.
Hi, sir. Shishir here. So just want your comment on the recent development where the where the IMF said that India has taken a good move as far as the digital payments are concerned. So just want to, and also it's quite important because you have taken a decision today also as far as the great lines are concerned through UPI. So want your comment on that, what probably the future scope of digital payment in India that probably in pipeline, probably RBI is thinking of.
You see, digital payments have come to stay. And in the last few years, I think in the digital payment space, India has made phenomenal progress. During the last finance ministers, central governors G20 meeting at Bangalore, we showcased various aspects of our digital payments, including the UPI, the CBDC. UPI we had also just launched before, a few days before the Bangalore meeting, we had just launched this facility of enabling travelers from foreign countries to also utilize the UPI to make local payments, even though they did not possess, even though they do not have bank accounts in India. The linkage with Singapore Pay Now and RBI's UPI had just been also launched 4 or 5 days before the G20 finance ministers and central bank governors meeting. That evinced a lot of interest. Now I think there is the phenomenal success of UPI in a large and populous country like ours has evoked a lot of interest. And I think going forward, already the RBI and the NPCI are in dialogue, in discussion with a number of countries to have similar arrangements as we have with Singapore, and to also enhance the footprint of the UPI. CBDC also, let me mention that the CBDC in the Bangalore meeting that is our version of the e-rupee, the central bank digital currency, was seen with a lot of interest. In fact, an eminent person from the international financial sector, he went to the extent of complimenting the design of our CBDC and added that the only thing he missed in the CBDC was the smell of a new currency note.
Thank you, sir.
I hope I got, okay.
Thank you, sir. I'll move on to Mr. Vishwanath Nair from BK Prime.
Governor, one of the criticisms of central banks during the unfolding banking crisis in the US and Europe was the quality of the stress tests that they were doing on these lenders, and that they were not up to the mark. I want to, you've specified that Indian lenders continue to be healthy, and that your supervision has evolved over time to nip the problem in the bud. But has there been any sort of tweaking of the stress testing that you do of the lenders in India?
I think you can take the question, you can supplement after that.
Actually, we have issued the guidelines to the banks that there should be a board-approved policy to use various scenarios to do this testing, not the single factor, even the multiple factor as well. As part of the FSU, the Financial Stability Unit, and the FSR Financial Stability Report, we do use various techniques to do this stress testing. In supervision also, we are keeping on stress testing of the entire portfolio on various parameters, not only the single parameter. So we do evaluate on various parameters. It's not basically required to be changed, because whatever parameters were required, those have already been factored this present situation as well, like interest rate risk in banking book. So those kind of things are already part of our regular stress testing exercise.
Like to add?
So if you've noticed in the financial stability report, we do a exercise called interconnectedness, how interconnected system and how contagion can spread. So we do what is called this solvency contagion analysis, which we recently revisited, and we find that if we take the NBFCs with the maximum potential to cause losses, and there is an idiosyncratic failure of those NBFCs, there will be losses to the banking system, but no bank will go below the minimum capital requirement.
Thank you, sirs. I'll move on to Ms. Swati Bhatt Shete from Reuters.
Thank you, sir. I had two very small questions. I mean, one was the withdrawal of liquidity. You said that it would be a multi-year approach. So I just wanted to understand if we would achieve the withdrawal of liquidity that you envisage by the end of this fiscal year, by the end of FY24. And so you had said previously that the 4% target on inflation would be met in the next fiscal year. As per your internal projections, does that still hold after the pause today? Thank you.
So taking your second question first, the forecasts are all the information that we have put into that thing, and we do inflation forecast targeting. In the next round of our review, we will factor in the impact of this move, today's move. The moves so far have started to take effect. As you can see, credit is slowing. Rate-sensitive sectors are already showing the impact of monetary policy. Now, as we progress with this cumulative action, it is possible that the forecast path will change towards the 4%, which we hope. And that is what we will review in the next meeting.
As of now, does it still get achieved in FY25 or does it not?
Yeah, the baseline forecast suggests that we will reach to 5.2 by the end of this year.
Okay.
Absent today's action.
Okay.
Okay. The cumulative action of past actions going through still, what we have seen so far, they will continue to play through, and today's action will also play. So it might change the path of the inflation rate in the next meeting.
Thank you, sir.
You didn't answer, sir. On the liquidity, will you achieve the withdrawal by end of FY24?
Actually, liquidity has already flipped. If you notice, we are already into repo transactions. The main operation became a 14-day repo, followed by a fine tune. At the current time, the government spending is so much that the system is flush with liquidity. SDF has now gone up to nearly 3 lakh crore. So we will see as it goes.
Thank you, sir. I'll move on to Mr. Roisuke Hanada from Nikkei.
Hello. Good afternoon. The next week, the spring meet will be held in Washington, and I understand the governor is going to attend it. And what kind of the discussion do you exactly accept on that meeting, especially regarding the financial new regulation of the financial framework? Thank you.
You see, the spring meeting of the IMF will be preceded by the G20 meetings, and the points which you mentioned are expected to be discussed in the G20 meetings. That is G20 meetings of the finance ministers and central bank governors. We have highlighted and stressed our priority in the last meeting of the finance ministers and central bank governors, and taking into account the developments which have taken place in the intervening period, and also taking into account some of the legacy issues which are persisting from previous presidencies. In other words, let me say that taking into account the legacy issues which are still persisting from the previous presidencies and the priorities of our presidency, broadly we will discuss the following points. One, we will discuss about, and these are our priorities, these are the Indian priorities also. We will discuss about the recent incident of stress in the banking sector in some advanced countries, to be precise, USA and Switzerland. Number two, making non-banking financial intermediaries more resilient. Number three, financial risks from climate change and the need for climate finance. Number four, macro-financial risks from crypto assets or cryptocurrencies or whatever you call them. Number five, managing risks from third-party dependencies, including big tech and fintech. Number six, enhancing cross-border payments. A point was made there. Number seven, better reporting of cyber incidents. Number eight, issues relating to financial inclusion. So all these issues are part of the priority of the Indian presidency, and they will be discussed at length in the G20 meetings of finance ministers and central bank governors in Washington, D.C., which will just happen in the preceding days of the IMF spring meetings.
Thank you, sir. So with your permission, last few questions I'll take before we close the press conference. So I'll invite Mr. Anand Adhikari from Business Today.
Good afternoon, Governor. So my question is on these small finance, banks. Now, if you look at these banks, they are focusing on unsecured microloans, serving the non-salaried class. And even if you look at the geography, they are concentrated in smaller geography. And I've seen, if you see the kind of NIMs they are offering, is much higher than the bank. So, they are able to offer higher deposit, rate also. So deposits in a way are also moving, to small finance bank, even in a small way. My question is, don't you think this kind of model could pose a threat, to financial stability, not in the next 2 to 3 years, but let's say 5 to 10 years down the line?
Now, let me respond in a couple of ways. First of all, these SFBs basically converted from NBFC MFI. So earlier there was a lot of concentration geographical as well as in the business. Now there is a roadmap where they are diversifying, and it cannot happen overnight. So obviously they require more time to really diversify. They are on the right path. Now, as far as raising the funds at the higher cost and offering the better NIM, we do track the business model of the SFBs. We also conduct the stress testing, and wherever we find that risk built up, we do advise the banks to take care of their risk built up.
Thank you, sir. I'll move on to Manish Suvarna from Moneycontrol.
Thank you, Yogesh. Good afternoon, Governor, sir. So my first question is on the RBI's inflation forecast for FY22. FY24 is little change, despite a big drop in your crude oil assumption to $85 per barrel. Does this mean factors like monsoon and exchange rate are expected to make inflation management difficult? And second question is on this unclaimed deposit. So you have said that you are going to develop a web portal. So when we can expect that portal to be rolled out? Thank you.
You can reply the first part. Portal you can reply.
On our forecast, the big change is actually in the second half of the year. Okay, and that you can directly link with what is happening right now. The high inflation of the current pay, yeah, exactly. Well, as I pointed out, that there is going to be a base effect playing. Because of high inflation now, you will get a favorable impact then. That is what has changed between February and today, because we got a print in between.
Regarding the portal, one, of course, it's for the unclaimed deposits and accounts which are transferred to the DA fund, which is maintained by RBI, and we expect the portal to be ready in about 3 to 4 months' time.
Thank you, sir. The last question to the Mint.
Good afternoon, Governor. My question is with respect to transmission of rates through the banking system. There seems to be a disparity in the way the transmission is happening with most of the public sector banks, maybe 50% of their loans linked to the MCLR, whereas private sector you see 50% linked to the EBLR. This is, which means that the rate at which the corporates, the rate of hikes that the corporate loans are getting priced at is much slower than the rate at which the price hikes are getting priced in for the retail loans. Do you think now this is the time for a sunset clause for MCLR? Because this is certainly a disparity between the corporate loans and the retail loans.
No, I think point which you make is the MCLR, the reset between the borrower and bank normally takes place at an interval of at least once in a year. So to that extent, the transmission may be slightly delayed. That is a point which can be noted. But having said that, I don't think there's any proposal being considered at this point to, provide a sunset clause for the MCLR. Thank you, sir.
With this, we come to the closure of the post-monetary policy if time permits, we have exceeded by 20 minutes of my scheduled time. So thank you everyone for participating in this press conference. I thank the top management of Reserve Bank, especially the governor and the deputy governors who made time to be with you today. Until next time, stay safe, stay healthy. Thank you very much.
Thank you. You can ask in the offline mode. No?